down. Thank you everyone for joining and welcome to a new year, 2022 Financial Literacy Series. The FOD, Friends of Odysseus, is a mentorship program, but we try to give back in many ways. And one way is trying to give financial literacy, try to give everybody advantage to have healthy, wealthy lifestyles. And, you know, a lot of times, you know, you go through school, school doesn't teach you how to budget, doesn't teach you about credit card debt, school debt, how to pay off debt, how to save for a house, and, you know, how to get loan forgiveness. So this is a great tool for everybody that's definitely either in school, out of school, or about to go to school. So we have our expert again, Anthea Perkinson, coming to speak to y'all all. So I hope you enjoy, and I hope you are attentive and taking notes. Please feel free to ask questions after each slide if you have any need for clarification, but I will pass it along. Floor is yours.
Thank you. I'm going to share my screen. And let's see. Okay. So thank you for having me back. I am delighted to kick off this month's series on financial literacy. We are going to change it up a little bit this year. We are going to start with investing because a lot of people are interested in the markets, and we want to capture that interest and work with it in a contest. So for those who are going to participate in this entire series, this educational series, we are introducing a 2022 investing contest. It will go the length of February. I'll give you a little bit of the details. Anthony will fill in the rest. He will also be the person to monitor how the contest goes. You see on the screen a website called Seeking Alpha. It is a website that most people should be aware of who are interested in investing. It's entirely free. It is a marketplace of investing ideas and information, and it provides a fabulous tool for creating a hypothetical investment portfolio. So here's the idea behind the contest. Anthony is going to organize those who are interested into different teams. Each team will select 5 stocks to monitor for the duration of the contest, so for the month of February. In addition to the 5 stocks, you're going to add either the S&P 500 or the Schwab Total Market Index, and you'll see why in a minute, to your portfolio. And he'll explain how often you are to send a picture of your portfolio to see how well you do. Now, you're going to use fake email addresses. And here's why. You're going to set up your own little email address on Yahoo or Google or Gmail rather. You don't want to use your regular email address because you will get more notifications than you will know what to do with. You can see that this trending analysis, all of those people send daily updates. If you follow a particular stock, as you would if you're competing in the investing contest, you'll get daily, sometimes multiple times a day, update analyst reports on those stocks. Now, I'm going to show you a portfolio that we created for the Mount Sinai Investment Club, which we initiated about 3 years ago. Graduate students from Mount Sinai Medical School got together. They were very interested. Many of them were biotech researchers. They wanted to start an investment club because they recognized the opportunity that if they knew more about investing, they could get in on the ground floor of some of what they discovered and hopefully become very wealthy. The club, people got busy. We created the portfolio. I think it's helpful for you to see what has happened in 3 years. It simply tells you that even when you know your field, investing is hard. Now, for this particular model portfolio, we picked 10 stocks. They wanted them, for the most part, to be in biotech. And we only invested $10,000. So we bought enough shares at the time to equal $1,000. But the fortunes of these companies have varied over time. And I just want to show you a little bit. You know some of these companies, they're big brand names. AMG is the trading symbol for Amgen. This did well, 5 shares purchased for $1,000, ended up being worth up 26%, worth $1,100. The next company, Biogen, at the time, this was white hot. Everybody was talking about Biogen, did not fare quite so well. Celgene was another biotech company. It was acquired by Bristol Myers Squibb. Excelsis, another biotech company, up 53%. That's a pretty good return. Next company, First Trust Biotech Index ETF. So what this is not an individual company. I'm going to explain a little bit more in my presentation what an exchange traded fund is, but this represents some diversification. This is multiple biotech stocks. It's done okay. Gilead Sciences, this one kind of sank. The next one is another, it's the iShares Biotech ETF. This is done rather well. The next one, Madrigal Pharmaceutical, another biotech company. This is probably the worst performer here. This was our measuring stock. A benchmark is the term we use in the world of investing. This is the Schwab Total Market Index Fund. So it's a very broadly diversified, it tells you what the stock market is doing generally. So are you better off investing in the biotech sector or investing more broadly in this type of an index? And over these 3 years, you would have been better off in this index. Just a point of comparison to measure your relative investment success. The last 2 are also ETFs. The top one is the Spider S&P Biotech ETF. Well, it's done okay. And the final one is the Healthcare Select Spider. Now this did well, but who would have predicted? It owns healthcare companies, pharmaceutical companies. We had a pandemic, and obviously those results are up. So it's not an easy game, even when you know your sector and you can make really calculated bets. But I encourage you to reach out to Anthony and participate in the investing challenge. It will keep you very interested in investing and will help keep you motivated through the course of our different presentations. So now I'd like to turn to today's presentation, some of the information you should know before you even create your hypothetical portfolio. We're going to go over investing basics, essential terms that you need to understand before committing real money. I'll explain what the keys to successful long-term investing are. They are simple, but not easy. I'll explain the concept of diversified investments. We're going to look at some historical stock market returns. It always helps to look at that context. And then lastly, because all of you are likely to work or want to work with an investment advisor at some point in your life. If not now, while you're in graduate school, perhaps when you graduate, you're earning a paycheck. And I want you to understand how they are organized, how they are regulated, and who provides what type of service to you. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. Now, this was authored by Benjamin Graham. He is the father of value investing in a book called The Intelligent Investor. This is considered an investing Bible. And basically what it's saying is that there's a big difference between investing where you are thoughtful and thorough and looking to ensure a return, and when you are simply making bets. And we're not here to encourage you to simply make bets. Speculation can cost you a lot of money. He has another quote: people who invest make money for themselves. People who speculate make money for their brokers. And for all of you who may be playing on Robinhood and buying some of those meme stocks, it seems like you're doing well for yourself, but do know that you are making the Robinhood fellas pretty well off. Investing basics. Let's start with a very terminology. There are three big asset classes that we all need to understand because they are critical to investing success. They are cash, liquid funds held in a money market account or a bank. They are bonds. Bonds are long-term debt that can be offered by corporations, by government entities, any entity that can tax, for example. You'll see in New York, we have the MTA issues bonds, and people buy them because you earn a return on your money. So you buy a bond and you are paid interest, typically twice a year. And at the end of the bond term, you are given your principal back. Now you can typically sell your bonds at any time during this period for either a gain or a loss, but if you hold them to maturity, you get your principal back. The other critical asset class is stocks, and stocks represent share in the ownership of a company, which is why it's referred to as equity. If you own shares in Apple, you have equity. You own a piece, a claim on all the assets and earnings of that company. There are also alternative investments. And if you listen to Bloomberg or you read the financial press, you will see that there is more discussion of alternatives, which really came about during the Great Recession. You may remember that in 2008, 2009, after the market collapsed, a lot of investment professionals were very concerned that in that event, when the market went down, stocks and bonds moved in the same direction. Everything went down together. Normally, stocks and bonds historically have moved inversely. So when stocks go up, bonds go down. During that collapse, everything went down together. So investment professionals began to look for investments that didn't correlate with stocks and bonds, that were not connected in any way. So they began to develop and to sell things like REITs. REIT stands for Real Estate Investment Trust. Typically, it's a collection of commercial properties. The portfolio manager invests in all of them, and you make money as a share of the mortgage payments or rental payments, and you own a claim on the assets. These became very popular, particularly when interest rates went low during the Great Recession, and it became a way for a lot of seniors to earn interest on their money. MLP stands for Master Limited Partnership. This is how a lot of other alternative type investments are organized into investments. An MLP might invest in oil wells, for example. A lot of wildcatters will set up an LLP, sell shares in it, and hopefully you strike oil, everybody makes money. Private equity and timberland are also ways that people diversify their money outside the traditional stocks, bonds, and cash. Other types of investment include currencies, commodities, and precious metals. We're not going to talk about those. Those can be fairly speculative and sort of beyond our scope here. Let's talk about the types of investments. We can all buy individual stocks and individual bonds. Easy to do, and we'll explain where you would buy them and how you would buy them. If that is not appealing, you can also invest in mutual funds, and there are a variety of kinds of mutual funds. You have mutual funds where essentially all the investments are in a big pool, actively managed by a professional portfolio manager who typically has a team of investment analysts who look for great stocks that should be part of the portfolio. And when you invest, you say, I'd like to invest $10,000 in the Fidelity Biotech Sector Fund. Your money is invested at 4 o'clock after the market stops trading so that they can tally up what the portfolio is worth and figure out how many shares or units your $10,000 will buy. If you don't like mutual funds, then there is a difference between actively managed. Actively managed, you have a portfolio manager making investment decisions, or you can have a passive index. Passive indexing is very, very popular. Vanguard invented this in the 70s, and it has really caught on. More money is going passive, and it's going passive simply because active managers, on average, don't outperform the stock market. So to save expenses, you could just as easily put your money in an S&P 500 or a total market index and get what the market is returning. Exchange traded funds are a little bit like a hybrid between a mutual fund, a passive mutual fund, and an individual stock and bond. I have a slide, a couple slides forward. We'll get into them in a little bit more detail, but they trade like stocks. You can buy it and sell it anytime during the trading day, but they're inexpensive and fairly static like passive index funds. And then, as I mentioned earlier, you could invest in real estate investment trusts and master limited partnerships. Now, how do we make money as an investor? Well, number one, if you're investing, you're truly hoping for a capital gain. This means you buy a fund or a stock for $100 and it goes up to $200. That's a capital gain. If it goes down from $100 to $50, that's a capital loss. Now, there's a couple things that are important to understand. We worry about realized capital gains and losses. What does that term mean, realized? It's an accounting term. It means that when your investment went up or went down, you sold and you captured that gain or that loss. Now, in the current tax code, capital gains, long-term capital gains, receive preferential taxation. Next class, we're actually going to get into taxation, something everybody should know about, because how much you keep from your investments is part of your return. But if you have a long-term capital gain, meaning that you've owned this investment for more than 12 months and a day before you sell it, you get to pay taxes using the preferential capital gains tax schedule versus the earned income tax schedule. And let me tell you, the capital gains schedule is much cheaper. In fact, depending on income, many people can pay zero capital gains on the first amount of capital gain they realize. We'll explain that next week. Short-term capital gains are taxed like regular income, so no preferential tax treatment. But long-term, that's important. If you sell for a loss, you can use long-term capital losses to offset long-term capital gains and owe no tax. You can do the same thing with short-term, okay? If you don't use up all of your capital loss, it carries forward, and you can use it in a future year to reduce your capital gains tax. The other way that investors make money are through the issuance of dividends and interest. A lot of stocks reward their long-term shareholders by paying out dividends. It is a portion of earnings. There are companies that pay it out quarterly, some pay it out semi-annually, some pay it out monthly. It all depends on the company. Bonds pay interest, and that's typically done twice a year. So these are all ways to make money. Now, where do we own our investments? There are a variety of places where we can keep our investments. You can open up a brokerage account. It is very simple. In fact, for the most part, most people now do this purely online. I walked a client through this yesterday. It took us exactly 15 minutes to get through the whole thing. Set up the account all the way to getting the account number. All of the investment companies, the big names, Fidelity, Vanguard, Schwab, are in amazing head-to-head competition. So there aren't any charges associated with opening up a brokerage account. Think of it as a box. It's a box you're going to establish into which you will put your investments. So when you open up a regular box or brokerage account, this is considered taxable, meaning that if your investments issue dividends or interest, it's taxable in the year that it happens. If you sell a particular investment and realize a gain, that will be taxable in the year that it happens. But you can also have a brokerage account for tax qualified, deferred money. For example, if you had an old 403B retirement savings plan or 401k from a prior job, you can roll that out into a rollover IRA set up in a brokerage account. So now you have a tax deferred account. And when you make trades in your rollover IRA, you will not realize current taxes. So you can buy stocks or funds, you can sell them, no taxes until you actually take money out of the account. Now, if you don't want to have a brokerage account, not sure why you wouldn't, but many people buy mutual funds direct. So you could go to any number of fund issuers and simply buy funds. I have a lot of clients, they tend to be older, and they bought all of their funds direct, and now they've got all these statements. And one thing I do try to persuade them to do is to eventually simply move these direct fund holdings into a brokerage account, just so you can deal with fewer statements and fewer tax forms at the end of the year. Another place where I encourage everybody to get involved as a saver and investor is an employer-sponsored retirement savings plan. If you work for a for-profit company, you'll be offered, generally, a 401k plan. If you work for nonprofit or a government entity, you'll be offered a 403b retirement savings plan. They work essentially the same. Those numbers, 401k and 403b, refer to the tax codes that govern how they operate, but both offer payroll deduction, tax deferred saving and investment opportunities. It is a wonderful way to grow your net worth over time. Begin early, contribute, hopefully get a match, watch these investments grow and compound over time. Lastly, I have up here stock employee ownership accounts. Well, I have I guess a question.
Yeah, Anthea, I want to go back to this, to the employer savings plan.
Yes.
So can you talk about the double benefit of not only growing your retirement dollars, but lowering your annual tax bill by maxing out those programs?
Yeah, I'm glad you're making me go back to that. Yes, when you contribute to a retirement savings plan through work, whether 401k or 403b, the traditional plans you're contributing pre-tax. So if you make $100,000 and you say, I'm going to put 10% of my earnings by payroll deduction into this account, you're only going to get taxed on $90,000. That 10% is in there pre-tax. So it is a wonderful benefit. It can help you really manage your current tax bill while you build wealth for the long term. Okay. Yeah. Okay. Anthony, you have a question?
Yeah, I wanted to know if you could speak to the stock dividend breakdown. I don't have a lot of money in stock, but I know every time I get an email about the dividend payback when they start splitting shares and stuff like that, get a little excited, and I wonder if I had more money, would I see more return?
Well, it would depend on the type of companies you are owning. There are some that are paying dividends to hold on to shareholders because they don't expect their share price to go up much over time. So they goose their dividends to keep people invested with them. So there are a lot of companies that have done this, a lot of big old American brands. AT&T pays a huge dividend and is owned for that reason by a lot of retirees. A lot of, IBM has paid a big dividend. GE used to, they've kind of fallen on hard times. So it would really depend. Dividends are great, but capital gains are where you really make money because there's a limit. You can only pay dividends to the extent that you've got excess earnings. consistent excess earnings. So going for a company where they're going to grow their business and their stock may appreciate in value, you're likely to make more money long term. But that was an excellent question. Thank you. So lastly, I'll comment on employee stock ownership accounts. If you work for a publicly traded company.
So Anthea, you have another
Yes.
question. Someone, this is, I don't know, this is a name. It starts, it's either Madeline Finesse or Maid. What is that?
Sorry. Yeah, thank you for bringing it up. I was asking, you were saying for the 401k or 403b, that if you get 100,000 and you contribute 10,000, then you get taxed for 90,000. Does that apply to the Roth IRA as well, or only the 401k?
Only the traditional 401k, and I'm glad you're asking that question. With the Roth, here's how the benefit works. You put in money into a Roth IRA or into a Roth 401k or 403b, you get no current tax benefit. So end of the year, you've made $10,000, you've contributed $10,000 into a Roth 403b, you're taxed on the full $100,000. But your benefit comes when you retire. When you are over age 59 and a half, provided that you've had this account for more than 5 years, and presumably you would, you can take not only your money, but every nickel that your money has earned over these decades being invested in a Roth 401k, tax-free. So that is a huge benefit. It is a wonderful thing to consider if you are young and not really worried about taxes right now because your income is modest. But building tax-free money for the future is super valuable. But great question. Thank you. So last comment on employee stock ownership account. If you work for a publicly traded company, a very common benefit is that the company will allow you to buy shares, either through payroll deduction or by check once a quarter, shares in that company at a discount. And the discount is typically 15%. So imagine you work for Google and the opportunity comes up to put a chunk of your money, and it will be a percentage of your income. They put limits on it. They don't want people to go crazy. And you can buy Google 15% cheaper than anyone can buy it on the stock exchange. You hold it for over a year. So now you have a long-term capital gain. If you're smart, you hold it for longer than that. And you have shares that you bought at a discount that can enhance your net worth over time. All right, now, as we continue on the keys to successful long-term investing, we really need to focus on two critical terms. Often confused, people think this is the same thing. It's not. Risk, when financial professionals are talking about risk, they're talking about the actual risk of losing your money, it going down in value or to zero. That is risk, risk of loss. Volatility is the fact that investments vary in value every trading day, depending on what the market's doing. Today was an up day. Felt good, see investments going up. It's been very volatile since the beginning of the year. If you follow the markets, you know that we ended 2021 strong. The S&P 500 was up 27.9% for the year, which is phenomenal. And many other investments were up as well. Since January, with what's going on with Russia and Ukraine, with the worry about the interest rates, Fed Chair Powell is talking about raising interest rates maybe as much as 5 times this year. This has caused people to be anxious over their investments, and they're buying and selling, and it's very volatile day to day. I have another question.
Actually, yeah. So I was curious, with the rates that you mentioned before in the MLPs, are those typically bought using any of those accounts or traded using any of those accounts that you mentioned before? Is that like a completely different platform?
So with master limited partnerships, most of them operate and you get what's called a 10K. So it's not quite the same as buying a stock or a bond. They tend to be fairly high risk. And again, my example was oil wildcatters. They collect money, they build the MLP. If they strike oil, great, but often they don't. So when you have a loss or a gain, you get a tax form called a K1. And it's just the tax implications are a little bit different. You also often have to hold them for a set period of time. The guy running the wildcatting outfit is not going to say we're going to return everybody's money or this is purely liquid next week. You know, we need the money for 5 years to go and see if these lands prove out. So it's a little bit different. Okay, so let's get deeper into risk and volatility. Standard deviation. I'm talking to science people. You understand what standard deviation is. It's used in investing to measure the volatility of an asset. Now, the market, represented by the S&P 500, is considered to have a standard deviation of 1. So every other investment is measured. What is its standard deviation relative to the S&P 500? We refer to that as beta. And you can have high beta stocks that move more than the S&P 500. Examples of those are typically young technology companies, high beta, very volatile, up and down. You can have low beta stocks. Examples of those are typically things like utility companies. Con Edison would be a pretty low beta stock. It's not doing a lot, it's not growing a lot, it's going to just chug along, okay? The higher the volatility, the more the price goes up and down. If you have a company with that kind of intense volatility, there is higher risk. Why is that? Since I've said that volatility and risk are separate things, when you look at some of these companies, what you discover is that they are very volatile and they are higher risk because they are higher leveraged. So young companies building out, you know, developing a market, new technology, whatever it is, they borrow money in order to expand their business. And if things don't play out right and they have to pay this money back, you could have, you know, a bad event and the stock could go down. It could actually go to zero if the enterprise, you know, completely fails. So let's talk about the factors that impact our individual ability to handle investment risk. 3 key terms: risk tolerance. There are 2 components to it: investment time horizon and need for liquidity. So what is risk tolerance? It has 2 components. One is, what is your financial ability to withstand a loss in an investment? If I invest $10,000 in a stock tomorrow and I lose that investment, you know, it blows up, you know, didn't do my homework and made a poor investment, is that going to change my ability to pay my bills? So that's the financial aspect of risk tolerance. There's an emotional aspect to risk tolerance. If you made that kind of investment thinking this is going to pay off, I'm willing to take the risk, I am just going to ride it out, are you happy with that? Or are you going to lie awake at night really anxious about the fact that the value of this investment is going up every day? And people are different. People have different needs for financial security of their assets. People want to know that their money is going to be there. And other people, much more comfortable taking investment risk. Investment time horizon refers to how soon you're going to need the money. If you are looking to buy a car or a house in the next 3 years, you're probably not going to want to put your money in the stock market because you've seen the volatility. It could be up or down at the time that you need to take it out and actually make that purchase. But if you're a young person just beginning your career and you are looking way out to retirement, and maybe you're mid to late 60s, you have a very long investment time horizon. You have lots of time for your investments to work out. This is a huge reason why I encourage young people when they're investing their 401k, their 403b, their IRAs, go equity. Don't put bonds in there if you're a young person. Go for something that has greater growth potential. Lastly, need for liquidity. None of us should put our last dime into our investment portfolio. If you have an anticipated need for cash, you know you've got bills coming up, or if you are going to face an emergency, and emergencies happen, you don't want to be dependent on where the market is to be able to take the money out. So you always have to have emergency savings first. Now, there are some great strategies for reducing the risk of losing your money. Number one, asset allocation, and number two, diversification. What is asset allocation? It's a very simple question. Yep, I have a question.
Yeah, I saw Keanu had a question. Keanu, do you mind coming off mute and asking your question?
Thank you.
Sure. Sorry for not doing so earlier. I had disturbance around me. But I just wanted to know if the benchmark for risk and volatility changes in a bear market versus a bull market.
I would say people's appetite for risk changes, and the mood of investors, both professional and non-professional investors, feel differently in bear markets. But in terms of calculating the risk, calculating beta, and looking at all the metrics that the numbers don't change, but people's attitudes certainly do. And you'll even see professional investors, the professionals who, for example, manage pension funds, will get very conservative in a bear market. They will take money off the table. You'll see more in bonds, you'll see more in cash, and they will wait it out rather than have that portfolio take on too much volatility. That's a great question. Thank you. So, asset allocation, essential question is.
You have another question, sorry. Before
sure.
You got started.
Absolutely.
There was one in the chat that said, what are examples of equity stocks? And Dr. Miller says, young people should invest in equity stocks, more risk, longer term investments. Can you please expound on those two?
Sure. So what are equity investments? They're stocks. What are great stocks to consider investing in? Think of the great brands that you love. We all work with Google. We all, a lot of us have Facebook accounts. Amazon, huge stock. Netflix, another great stock. These are, Tesla, another great stock. They're not all, some of them are fairly volatile, but they have been very successful companies. These are great brands that sell product across the globe, and these can be good long-term investments. Now, I am biased. We'll talk about diversification. I think buying these stocks inside an index or a mutual fund is a good way to get started. What I counsel a lot of people to do is what's called a core and explore strategy. Your core is a great index fund, maybe the S&P 500, maybe a total market fund. That's your core. That doesn't change. You stick with that through, thick and thin. Your explore are some of these stocks you're curious about. Take a little position in a company you're interested in, add to it, maybe sell it if it doesn't work out, but you don't put as much at risk because most of your investment money is in that nicely diversified index fund. Okay, so.
Oh, we got two more questions.
Sure.
See, Dr. Mansell, can you please come off mute and ask your question?
Hi. Yeah, I think equity stock, I think you explained it when you answered the other question, but just for an example, is most of the stocks that's in the S&P 500, would you consider at least most of those companies equity stocks?
Yes.
And then more volatile or young, maybe startup companies like a non-equity stock, and then that's what you would explore with? So core equity S&P, non-core explore, like startup companies or something that you're just interested in?
Yes, but let me just clarify. They're all equities, meaning that if you buy a stock, you're buying equity in that company, whether it's a big successful brand like Amazon or if it's a little, biotech startup. But yes, what I was describing is exactly what you said. Buy these big stocks in the S&P 500, and the S&P 500 are the 500 largest stocks by market cap in this country. So it is a big established fund, long track record. We're going to look at some of that in my later slides. So it's a great place to put your money. And then dabble in some of these other companies and see how they do. You might pick a winner, but then you might not.
Got it. Thank you so much.
You're very welcome.
And then Dr. Augustine.
All right, thank you for coming to this talk. Basically, I had a question regarding investing in an IRA using the S&P 500.
Yes.
So basically, at the start of this year, I was planning to start an IRA account for myself, but I could see that like how the market had been going up consistently to the point where I thought there would be like a correction or a crash sometime soon. So that's why I waited out this month, and I saw that it did dip. So basically, my question is, when investing in like an index fund or S&P, like some people have told me that you shouldn't worry about the market, where the market's at the time, because long term is probably going to go up anyway. So I wanted to ask what your opinion on that, and also too, given that there's a dip in the market right now, would you say that it would make sense to maybe wait longer before starting the account, or yeah, what's your opinion?
So with an account like an IRA that you are investing now for a goal that's decades away, the exact price you buy is less important than getting invested and beginning the opportunity to grow and compound. So this is a good time to invest. I've been adding money to the market. We have a down day. I move a little in. I did my IRA contribution, I think the first or second week in January, when it looked like everything was going kaplooey. This is a good time to start. And then you'll add to it with the IRA for next year. You can actually right now, if you have the money, do two contributions. Until April 15th, you can put in money for 2021. From now until next April 15, you could put in money for 2022 tax year. So if things really go down, and I'm not saying that they will, might be a good time to get both of those investments done. And I like your idea of doing the S&P 500, fabulous long-term investment to hold. Great question, thank you.
But Anthea, can you just reemphasize, because at the beginning of that question, I heard I was going to invest in an IRA and then I waited. Is there any reason to wait when you're working to not invest in an IRA?
So one thing, just the mechanics of how it works. When you open the IRA, you're literally opening a box titled IRA. You could move cash into that account and invest it at any time. So moving the cash in gets you the tax deduction. Investing it gets you the long-term return. So I would encourage you, move the cash in now and be ready to invest it. Maybe the stock market, stays the same. This is a relatively good time to invest because it's down from all-time highs. But you're going to stay invested for a long time, for that investment to grow and compound. So.
And in the short term, you get the tax benefit.
Yes, you are.
So that's my point. There's no reason to not have some money in an IRA if it's available to you, because you're just hurting yourself in the short term and the long term.
Yes. Mm-hmm. It's, as the expression goes, it's time in the market, not timing the market, that makes the biggest difference.
Okay.
Thank you for
Anna. Go ahead.
Yeah, thank you for clarifying that further. But I have a follow-up question based on what you said. So you said that just by starting the account and putting the money in, you get a tax benefit. But
yes, if you're
yeah, because I was confused because I thought you had said before that that money would be post-tax.
So
IRA.
Are you making a Roth IRA or a traditional IRA contribution?
A Roth IRA.
Okay, so then you're putting in after-tax money. So you don't get a tax benefit right now. You have the tax benefit down the road when you can take out both your earnings and the original principal tax-free. Mhm. I should have asked whether it was Roth or traditional.
Thank you.
You're welcome. Okay, so asset allocation, it's divvying up an individual's investable assets among stocks, bonds, and cash. So basic question, how much are you going to put in each bucket? And you make this decision based on the individual's time horizon. When are they going to need the money? Risk tolerance level, how anxious are they going to be to invest? Need for portfolio liquidity. And again, we're not going to invest the last nickel. We have money set aside for emergencies and living expenses. And then lastly, tax sensitivity and unique circumstances. For example, I bring this up because we live in triple tax New York City. We pay income tax at the federal level, the state level, and the city level. So if I'm doing an investment consultation for somebody in that situation, I'm going to be very careful not to recommend a fund that throws off a lot of dividends and distributions that is going to be invested in a taxable account. I don't want to create a bigger tax problem for my client. So these are the considerations. I'm going to move to the next slide and I'm going to answer this question. Okay, Karen Alvarez.
Hey, thank you so much for this wonderful presentation. I'm currently a first timer with my Roth IRA, and I'm
Great.
starting investing $600 every 2 weeks to complete by April 14, the 6,000.
Great.
I'm currently making an investment in a target date index fund, and I
Okay.
would like to know if that's a good allocation, as I know like it changes as I get older. But I don't know
Yes.
if I should be like making my own portfolio, which I'm kind of afraid because I'm like a beginner, or I should be doing like that.
So in retirement account investing, for people who are just anxious about, how much they know on investing, target date funds are fabulous solutions. So I would stick with it. You're a young person. I'm sure that you are looking at a target date fund that goes out to 2045, 2050. And the way that works, I'm glad you mentioned target date funds. The portfolio manager manages the asset allocation for you. So early on, as you're a young person, far from that target retirement date, your portfolio is mostly in stocks. You can take that risk because you've got this long time horizon. When you get to midpoint in your career, they start to make this portfolio more conservative. So for example, it will get to the point where it's half bonds, half stocks. And then as you approach traditional retirement age, it will become more and more conservative so that on or about your expected retirement date, it's going to be bonds and cash equivalents, meaning money markets. Now, that gets you to retirement. That's a perfect solution. I would not, change that strategy if that gives you comfort. As a retiree, you can't have everything turn into cash for you, but that's a conversation for another day.
I'm sitting here interested. All these young people are investing in these Roths, but they're getting killed up front on the taxes. They're paying this is after tax dollars. What's the recommendation here?
That's a great question. And here's my question back. Early in your career, are you making big bucks? Are taxes your biggest concern? It might be more in your best interest to invest using a Roth because you don't really need the tax deduction. Your tax rate's not that high. It's not a big problem yet. Let that money grow and compound tax-free forever. You'll get to a point in your career where you're making too much money and you really need the tax deduction offered by a traditional IRA. But early on, you have a wonderful opportunity to fund a Roth. Okay.
Great, thank you for that clarification.
Okay.
So these young people, they're actually ahead of the game.
Yes. And they'll have enormous Roth accounts. And I can tell you, when I work with older pre-retirees and retirees who have a lot of Roth money, that is just a wonderful situation because as you get older, we're going to talk about this next week, particularly once you retire, virtually every nickel you take out of your accounts is taxable, and you can end up in a very tough tax situation. So Roths are great. All right, so we talked about asset allocation and how do you make that decision? How do you make the decision whether to invest most of your money in stocks, some in bonds, some in cash? It's a straightforward process. When you walk into a wealth manager's office or you sit down with somebody from Fidelity or Vanguard or Schwab, they're going to take you through a risk tolerance questionnaire to find out how comfortable are you with investment risk. Do you have assets outside your investment portfolio? And what they're trying to figure out are the answers to the questions on the left. What is your investment objective with this money? Are you looking to grow your money for the long term? Are you looking to generate income? That's your investment objective. How much return are you looking for? What's your risk objective? And these things should be consistent. If you are looking to grow your money aggressively, you need to be able to stomach some investment risk. Are there any constraints on the way we invest? For example, does this particular investment need to have some liquidity? And there are people who need to keep money kind of loose in some of their investment portfolios. What's the exact time horizon? When will you need to take this money out? Do we have tax concerns? Any legal or regulatory issues that apply? For example, if you are somebody who works in public office, or if you are somebody who works in the investment business, that needs to be disclosed when you open up your investment account. There are special reporting requirements. Any unique circumstances. All of this frames how we are going to allocate our investable dollars into stocks, bonds, and cash. You can do this for yourself. You can sit down with a piece of paper and just figure out, what do I want to make happen? What constraints do I face? And am I committed to my return and risk objective? Why is this initial upfront decision so important? Well, because different asset classes perform differently as business conditions change with the business or economic cycle. These changes in the economy can impact investment returns. And I have a picture of this so that we can all see what I'm talking about. This is a simple schematic, this line drawing of the market cycle, also known as the economic cycle, also known as the business cycle. Right now, we are on probably the upswing phase, probably near the top, right? So we remember way back in 2008, we were in a deep recession. And we remember that the president at the time was trying to stimulate the economy. They were dropping interest rates, make lending cheap, so people would go out and borrow money, start businesses, buy things. Interest rates were low. The stock market started to rise. Now, we had a very interesting experience during the pandemic where people panicked, the market tanked. It was very temporary, came right back up. And if you watch the markets, you know that all of the work from home type stocks just went on a tear. And that has persisted for 2 years now. Right now, we're in an interesting spot because we have inflation. Now, the inflation was described as transitory, meaning that it's related solely to the shipping problems. We can't get goods, things are stuck on cargo ships from China, it's not getting in, stores don't have goods on their shelves, and so prices are going up as a consequence. We have, as a result, Federal Chairman Jerome Powell talking about raising interest rates to nip inflation in the bud because people are complaining. Regular working people who have to pay more money for food and clothing and rent and services are starting to feel it economically, and it's giving them stress, and they're mad. The Federal Reserve will raise interest rates. They're talking about doing it either 3 or 5 times this year. Typically, it's done 25 basis points to 50 basis points at a clip. And the whole idea is if you raise interest rates, you slow down borrowing. Mortgage rates go up. So this hot housing market might cool a little bit. And prices will come down because they've been bid up. Same thing, stock market might come down a little bit. We don't know. Sometimes it does, sometimes it doesn't. But all of the ways that higher borrowing costs will slow down spending will tame this inflation. Now, know that in history, the Federal Reserve has made some bad calls. They raise interest rates too early, and the markets go down, and in business slows, or they raise it too often, and the same thing happens. And this can tip us, the market, the business cycle, into a recession. We'll keep our fingers crossed that this doesn't happen. There's no reason that they can't get it right, but we'll see what happens. So I mentioned that companies' business fortunes change with that market cycle, with the business cycle. Investment analysts have very helpfully organized the world of investable companies into different sectors. They're called industrial sectors. They share certain similarities. Then they cut them up into three basic groups. You have companies that are cyclical, meaning that their business fortunes go up and down with the business cycle. Think of things like pickup trucks. New fancy pickup trucks. So it's an example of a very cyclical business. Sensitive industries are sensitive specifically to interest rates. Banks and insurance companies. It's a big deal. When interest rates go up, banks and insurance companies will make more money. Defensive companies, doesn't matter where the market cycle or the business cycle is. People are going to buy their products regardless. A good example are baby diapers. So, whether we're in a recession or we're not, you're going to buy baby diapers. So consumer durables, consumer defensive stocks, those will do well regardless of where the market cycle or business cycle is. Now, if you'll see at the bottom, it says top-down versus bottom-up investment analysis. There are two ways that people, financial professionals, find investment opportunities. You can have what's called a top-down selection process, where you look at what do we expect the economy to do, what are business conditions looking like for the next year to 5 years, and based on what they think is going to happen in the market cycle, the business cycle, they select their sectors, and within those sectors, the companies they want to invest in. The opposite is what's called a bottom-up investment analysis, also known as fundamental equity analysis, where analysts find great companies. They're reading financial statements, they're talking to vendors, they're exploring the contracts that these companies have, the product reviews, the market share, and they say, without any regard to how the economy might do over the next so many years, this is a great, well-run company. I have great confidence in their product, in their ability to manage their business. This is where we should invest. So two very different ways of looking at the world of investing. What has the greatest impact on our investment portfolio returns? Asset allocation. And here's why. We make this very basic decision. Right, here's from our earlier slide. Now in color, we have stocks, bonds, cash, but we can drill down even more finely. Within the world of stocks, you can invest in international equities. In fact, not just international, you could have international small cap equities. You can have small cap value. Now, value and growth are two styles of investing. Growth stocks are those that are expected to grow faster than average, faster than their peer companies. Value companies are companies that, for whatever reason, when you look at this business, it's not valued as in a way that represents the true economic value of the company. So they're undervalued. Warren Buffett and Berkshire Hathaway, this is the way they invest. They are the traditional value investors. They're looking for the overlooked companies that, you know, with a little bit more time and attention can raise their share price and make him a big capital gain. Also within equities and within stocks, you can have large cap, and large cap represent companies $10 billion or larger. You can have them in the growth sector, you can have them in the value sector. Okay, so there are many ways, many fine ways that you can carve up your stock portfolio. Now, your asset allocation corresponds to your investment objective. These things have to be in sync. You can't, for example, say that I want an income portfolio and have an objective for growth. So if you're investing in an income portfolio, you look here and you'll see it's 70% invested in bonds, 30% in domestic equity, meaning US stocks. That may grow. It may have some capital gain as you own it, but by and large, what you are earning from that portfolio and what you should expect to earn are interest payments from those bonds. Now, if your investment objective is growth, you can go growth, traditional growth in the middle at the bottom, where you've got 65% of your investment in domestic stocks, 20% in bonds, 15% in international equity. And I will say, most Americans really just like investing in the US, but there are wonderful investing opportunities in other countries, worth a look. If you are an aggressive growth investor, you'll see that there are no bonds. And for young people who've got time and can just leave this money invested and leave it alone, that can be a good approach for some of your investable money. Your investment objective, your asset allocation, determine your returns. And again, same thing, if you want a conservative portfolio, you shouldn't expect your portfolio to hit it out of the park in terms of investment performance. These numbers are a little bit dated. If you look, for example, at aggressive growth, you'll see average annual return 9.47%. I think that's higher now. We've had a long bull market. It's been year after year of double-digit gains. So I think these average returns, I should probably update this slide to show that they are higher. But you'll see when you add more stocks, and you have mostly stocks and international stocks, you have the potential for greater returns. And here, see the best 12-month return, 136%. That's not going to happen in a bond fund or a portfolio, a conservative portfolio that's half bonds. So we need our objectives and our return expectations to be in alignment. Why is it that different types of investments have different risk and reward? Here is a trade-off graph. You'll see on the x-axis the return percentage, and along the y, the standard deviation. How much does this particular investment differ from the S&P 500? And you'll see at the very bottom of the graph line, a money market or government treasury. It's going to have low risk, but low return. You want a little bit more return, we go out to an investment grade bond. Still not enough return, we can then go to a blue chip. Blue chip is a large cap, well-established company. Unlikely that they are going to grow in an exuberant way for an enormous gain. It does happen, but it's more rare. But they tend to be very consistent in their business, very methodical in their processes, very well managed, very well invested. So for some more risk, but not a lot, you can get more gain than investing in bonds. You want to take it out a little bit further on the risk-reward trade-off, mid-cap equities. These are up-and-coming companies. They've had some success. They're still small. They're agile. They tend to do fairly well, particularly when the economy is on the upswing. And then the most dynamic of all, small cap. These can go great guns and be highly successful, grow into a mid cap, And you'll notice what happens is that they produce less return as they get more established. They kind of move this way as they get bigger. Because the other thing that can happen and why they are so risky is they can blow up. So that is the risk-return trade-off in a different type of graph. Another strategy for reducing risk is diversification. It's the old adage, don't put all your eggs in one basket. We want to protect against the unique risk of individual securities. You don't want to over-concentrate in any industry, sector, or asset class. And the portfolio I showed you from the Mount Sinai Investment Club is a little bit of a cautionary tale. Everything was in biotech. If biotech had done well, that'd be a great portfolio, but it's done average. There's some winners and some losers. So you want to diversify so that you don't take too much unintended risk. How do you achieve diversification? Well, you can buy different stocks that differ according to size, capitalization. Large cap, I mentioned, $10 billion in market cap. Market cap is the share price times the number of shares outstanding. That is market cap. Gives you a sense, sort of a measuring stick for how big a company is. You can diversify by style. I mentioned value stocks that Warren Buffett loves, growth stocks, or you can have a blend of the two. There are a lot of funds that have a blend. They're very opportunistic. When value is in vogue, they buy value stocks. When growth is doing well, they buy growth stocks. You can vary or diversify by location, buying domestic or international funds. And as I showed you before, you can vary and diversify what particular investment sector you're invested in. The advantages of mutual funds. They are, by their very nature, diversified. They offer professional portfolio management. They have a defined investment objective. So if you buy a growth fund, that's where you invest. It has to stay a growth fund. It can't decide one day it wants to become an income fund. They have standardized investment return reporting. So you can see how well you're doing relative to the benchmark and relative to other funds that are pursuing the same objective. Easy to buy and sell. All of the trading effectively happens at 4 o'clock at the end of the market trading day, but it's simple to get in and to get out. They automatically rebalance, so you don't have to worry about that. And you can decide if you want an active portfolio management strategy or a passive strategy. Types of funds, I mentioned index funds, referred to as passive investing. A computer monitors it. Say, for example, the S&P 500, we know it's the 500 largest companies in the United States by market cap. That list doesn't change often. Once every couple of years, a company goes out and a company gets added. As a consequence, a computer can manage the cash flows in and out of an index fund. You're not paying a fancy pants professional manager and a team of analysts, so the fees inside the passive index funds tend to be very, very low. Fees are paid by your returns, so lowering your fees can improve your returns. You can pick a growth or a value-oriented fund, growth or income, which is an investment objective, emerging markets, alternative investment funds, or sector funds. Things to think about as you are making your selections. Look for low management expenses. No reason to overpay, particularly since it comes out of your return. I have a question.
I just had a quick question about what you said about fees versus returns for the index fund. Could you repeat that?
Sure. Index funds have low management fees. When you look, for example, on a fund fact sheet, it will give you the management fee that is charged to be in that fund. Active managed fees can be as much as 1.5%. I've seen 1.9%. Index funds tend to be more like 0.4, 0.3, so considerably less. So you get to keep more of the returns. Okay.
Thank you.
You're welcome. The other thing to look at as you're evaluating mutual funds, look for good longer-term investment performance. Anybody can get lucky. They can have, some big company, some crazy experience, Tesla on a tear, for example. Are they consistently beating their benchmark and their peers over multiple years? Do you have a talented portfolio manager, or was he just somebody who was lucky? The stability of the portfolio management team matters. And I say this having just been burned by a huge capital gain distribution on a small cap fund that I inadvertently thought was an index. Turns out it was actively managed. They brought in some new gunslinging portfolio manager who sold everything and reinvested the portfolio. When they make that decision to reinvest the portfolio, to sell everything, they realize all these capital gains that have been building up in this bull market. I and all these other investors now have to pay taxes on that capital gain. Yes, a good problem to have, but I didn't see it coming, so I wasn't able to plan and get in front of it. So stability of the portfolio management team is something to look for. Low portfolio turnover, just as I was describing, when they turn over positions, you generate capital gains. If they're not offset by the manager by portfolio losses, you are going to get a taxable distribution if you own this in the taxable brokerage account. Good investment performance relative to peers in the benchmark, particularly for longer periods, not 1 year, look 3 years, 5 years, 10 years, and since the inception of the fund. I mentioned that I had more information on exchange traded funds. These are very popular right now, and they were developed back, I want to say in the 80s going into the 90s for institutional investors to be able to lower their transaction costs. They never intended to offer them to retail investors, but they are great. What they are, like an index fund, all of the investments inside your exchange traded fund are static. They don't move. So think of buying an ETF like buying a 6-pack of soda. Each of the cans or bottles may be something different. You might have a Sprite, a Dr. Pepper, an Orange Crush. They're all different, but the 6-pack doesn't change. And you can buy that 6-pack anytime during the trading day and sell it anytime during the trading day, unlike a mutual fund where that only happens after 4 o'clock. So you make the decision when to buy or sell it. Your 6-pack is static, so you don't have inadvertent generation of capital gains from the portfolio manager turning over the investments. That in that way, it's closer to a passive investment than to an active investment. And for this reason, the fees, both transaction costs and the management fees, are tiny, really, really tiny. So it's got a lower overall cost structure than most mutual funds, most active mutual funds for sure. Often they're lower cost than traditional index funds, and they give you tremendous tax control because you decide when you are going to sell it and realize your gain or loss. So we're at the end here. We're going to look at some historical stock market returns. Just want you to have a picture of this because it kind of puts all of this other information in perspective. This is what gets people excited about investing. Long-term stock market rates of return average 7 to 10% annually. Now, right now, you're not going to get that in the bank for sure. But if you invest in the stock market, last year I mentioned S&P 500 returned 27.9%. But over the long term, this is what you build your models, your investment models about, 7 to 10%. Long term is 10 plus years. So if you have 10 plus years, you don't necessarily worry about, the next recession, a market crash. You've got time for this to grow and compound at approximately 7 to 10% annually. Here's a picture. Now this only goes through June 2017, but what I wanted to show you is a very, very simple line graph of where the S&P ended every day between 1950 and 2017. Just so you know, the S&P 500 today, 4,509 when I looked at the close. So it's up here. It's way up here. It's gone pretty much straight up with very few hiccups since the Great Recession. These gray lines are important to see and to understand. These are recessions. So you'll see this big fat line was the very deep and prolonged recession that happened after the housing crisis. So that was extremely painful. That was an awful experience for people who were working, for people who were retiring. It was really a lot of dislocation. Other recessions have been more brief and slightly less impactful, and they vary over time depending on what happened to cause this. Part of the reason that this was so deep and so broad, meaning it lasted so long, is that there was an element of financial fraud involved. The mortgage industry turned out had all of these problems that people were not really talking about. We had credit card companies that were abusing consumers, and they ended up, going in front of Congress and getting some new rules put on how they declare interest rates and how they treat their cardholders. So once a lot of these bad practices were cleaned up, things are on firmer ground. And we've had some dips, some, bad days, bad weeks, a bad month or two, but it has been remarkably bullish. This is more or less that same slide, but formatted differently. So you can see the events that triggered these big sell-offs. So we're all familiar with the housing bubble, how everything got big and frothy. Everybody was, gung-ho investing in stocks. And then the whole thing went kaplooey and it felt pretty grim. We're obviously recovered because we're way up here since there. But there were other events, some of them domestic, many of them foreign, meaning happening elsewhere in the world, that's triggered a sell-off, a loss of confidence in world markets. These tend not to last, which is why I encourage people, don't stress over this when you're investing for the long term. Bad things may happen, but the market seems to adjust and grow. And so long as the economy is working, the markets should do well. This is one last picture, and I like this one. And I'm talking to a bunch of scientists, so you get statistics. And your first impression as you look at this is like, wow, all those annual market returns, S&P 500 between 1927 and 2003. Looks almost like a normal distribution, doesn't it? You can see you've got tails that are out there on the ends. What's curious about this is that almost 2/3, or actually 3/4, 73% are positive years. Now, positive can be from 0 to 60% returns. The negative, almost 25%, can vary from 0 to -50. But what's interesting, even though this is not a perfectly normal distribution, don't be fooled. The measure of central tendency, remember that term? In here. Most of your returns are going to kind of end up in here. Last year, 27 was an outlier, 27.9%, so that'd be on this pile, tilting this a little bit more this way. But that's why, on average, long-term returns, 7 to 10%, because that's most likely what's going to happen. Okay, so visually interesting. All right, 2 minutes on investment representative, advisor, or planner. And again, I offer this because I want you to be informed consumers when you want to engage a professional for investment advice. Investment representatives can buy and sell investments for you, usually for a commission. They are required to consider the suitability of an investment or recommendation for your individual situation and objectives. So if you come in and a growth fund is fine, they can sell you a growth fund. They don't have to go any deeper than that. They're regulated by FINRA. Investment advisors buy and sell investments for you, usually for a fee based on assets under management. That's the most common scheme right now, with compensation scheme. They are required to serve as a fiduciary. This means they have to put your interests ahead of their own. This means that if they're considering a growth fund for you, because that's the right thing for your situation and your objectives, they got to look for one that has a low fee, that is going to be the perfect solution for you. So this best interests in making these recommendations is a big deal. So remember this term fiduciary, so that you know they are working on your behalf. Now, here's a term you see all over the place, financial advisor. And here is what is a little challenging about that name. It's kind of all encompassing. Financial advisors are often a hybrid. They can be regulated as an investment representative, serving as a broker, buying and selling for a commission, or they can change hats and operate as a fiduciary. And there are a lot of investment firms where you walk in and they want to prepare a financial plan for you or an investment plan for you, and they serve as a fiduciary and saying, well, you need this much in growth stocks and you need to invest your money this way. Then they spin around, change hats, and want to actually sell you the investments that go into your plan. So this can be very confusing because they are not always operating 100% as a fiduciary. So certified financial planners are always held to the fiduciary standard. Okay, many of them work under RIAs, so that sort of forces them to be a fiduciary in order to offer investment advice. Some are fee only, some charge by the hour or by the plan, and some charge an asset fee. But understanding who will serve as a fiduciary and asking that up front is the best way to protect yourself, to make sure that you're not just working with somebody who's really interested in the commission above all else. Happy to answer any questions you might have. Based on the material, I realize we've gone over by a bit. I hope you had your questions answered.
So this is great. Before we start to lose folks,
yes,
Anthony, can you tell people quickly how this investment challenge is going to go forward for you, Anthea, so they just get that information?
Okay. Yes. If anybody's interested in joining the teams, I currently made 3 group emails through Google, through the Google Gmail account. I will try to divide up those that are interested in the game. We'll send you your login information and your team as I divide it. What you're gonna do is after you create your group, your team name, you're gonna pick 5 stocks, buy 1 share of each stock and you said S&P 100, correct, Anthea?
500.
Oh, 500. So that's 6 stocks total. You're going to take a screenshot of just your main page before the day starts, the trading day starts. And then at the end, before the last day of the month, you're going to send me a screenshot of that same main page. And it's going to show how your investment started and how they've grown or changed over the during the month of February. And then Anthea we will forward you the 1-page questionnaire that you have to submit to us, and we will pick a winner based off of that information.
What are the investment amounts each team?
At this point, we'll try to say there's not a lot, so maybe 20 to 30,000, since we're only buying one stock of 6 different shares, 6 different stocks, and we're buying 1 share. It shouldn't be that much, but yeah, the maximum is 20,000 for one share.
So I thought we said 100,000 for the team.
Yeah, 100,000, but I don't think buying 6 shares of 1 stock will equal 100,000. So I guess the max will be 100,000. So that will set the max of 100,000 of all 6 of your shares. And I put my email in the chat box, so anybody's interested in being divided into groups, just email me, let me know you're interested, and I will divide the groups up and we'll begin to play this financial investment game.
So Anthea, can you give folks a little bit more? I know there's a question, Edward has a question, but can you give folks a little bit more detail on how this is actually going to play out?
Yes. So when you get together with your team, you should figure out, what kinds of companies do you want to invest in? Do you like biotech because that's what you're familiar with? Do you want to do pharmaceuticals? Do you want, it can be anything. Companies that you find fascinating that you think are going to do well this month. You, as a group, decide which ones you will invest in. Take the whole 100,000, invest it over all of these. Make sure that stock number 6 is the S&P 500. And we're going to look at this, Anthony and I, every week and see how you do. What I am interested to see is what decisions, what criteria did you use to make your stock selections? How much deliberation? How volatile is your portfolio? So I'm interested to know toward the end of it what your selection criteria was and whether, if with your own real money, you would make these same investments. Mm-hmm.
And just to let everyone know, the recording, once Zoom finished processing, I will edit it, put it on the website, and then I will send you in the email link so that you can view it on YouTube and at our website.
So we have 2 questions, one from Eduardo and one from Keanu. Eduardo, do you have a question first?
Yeah. So I have 2 questions now. I'll ask the first one is so for the investment contest, I kind of came a few minutes late, but it seems like you were talking about using the website Seeking Alpha.
Yes. Yes. And the reason to use Seeking Alpha is that you can set up a portfolio, pretend to buy actual shares, and it's going to track how that investment does for the whole duration of the contest. So all you have to do is put the shares in on the day that your group comes up with the portfolio, and then we can track it. So you can look at it as many times as you like. It's a great place to learn and poke around. I did see a question, where can I learn about individual stocks? A lot of research reports, a lot of information available for free on Seeking Alpha. But do use the Google Gmail email account because they will send you so much email. It's just incredible.
And Anthony, you've already set up accounts for everyone. They don't need to set up any individual accounts, right?
No, I set up a group account for, nobody has to set up an account. Just send me an email and I will divide you up into teams and provide you with that email login information.
And it'll be random, so you don't have to pair. Just tell Anthony you're interested. He'll just put you on a team.
Mm-hmm. And we had a question from Dr. Mansell. I know it's been in the chat for a second. Can you come off mute and ask your question?
Yes. It's a 2-part question. So there's traditional IRAs and there's Roth IRAs, correct?
Yes.
Okay. So one IRA, you can put your money in without it being taxed, and another IRA that you have to pay the taxes on it, and then you can put it in the IRA.
Correct. The first one, the traditional IRA, you put the money in pre-tax. And what happens is it's pre-tax because when you turn around and do your tax return in April, you are going to claim that you made a tax deduction, and that's going to reduce your income by $6,000. With the Roth IRA, you don't do that. You just take money out of savings, put it into the Roth IRA, and leave it alone. Mm-hmm.
Right. But the difference is the Roth IRA, I think what you were saying is better for younger people because you can just pay the tax now, it'll compound over time, and then you can pull it out without a tax deduction.
Correct.
But with the traditional, you don't pay the tax when it goes in, but you have to pay when you withdraw.
Exactly right. Yes.
Yeah, so you still got to pay taxes regardless, in some form.
Uncle Sam needs his money.
Understood. And last but not least, when you go to these investment companies, you're going to give them a goal and some financial assets, and they will advise you, hopefully, with their interest to generate an account for you, and then they'll manage it.
You can do that, yes. If you want to have an investment advisor, make sure they are a fiduciary. Ask them that specific question. Will you always work in my best interest as a fiduciary in all matters regarding my account? And if they can't answer yes, you should look for somebody else.
Right. But I could also just take my money and invest it on maybe Seeking Alpha or Robinhood and manage my money myself, even though it's risky because I'm not as knowledgeable. It's full control.
Correct. I would not, personally, I would not recommend Robinhood. And Seeking Alpha is more of a training tool than it is an investment company. But you could set yourself up an investment account at Vanguard or at Charles Schwab and select investments. They have very good websites. You can learn a lot about the basics of investing. And that is another good way to start. The reason I'm down on Robinhood is that when that company first came out, it was all about gamification, getting people to trade. And they say now that they're publicly traded and the SEC has kind of cracked down on them, we're not about gamification, we're not about options. But when you really drill into what they offer, what they really want people to do is to trade using options and to trade on margin, meaning you are borrowing money to make a bet. And that is a good way to get hurt. You can lose more than you invested when you borrow money to make an investment. So that's why I'm just a little bit down on the Robinhood crew.
Okay, we have a couple other questions. We got to keep it moving here.
Sure.
So Keanu, you've been waiting for a minute.
Yeah, I just wanted to know if we would have access to the slide deck that was just shared.
Yes, I will send it to everybody that attended this meeting.
Thank you, Mr. Small.
Alex.
Yeah, hi. I just had a quick question because I know with the 401k and the 403b, I believe they bumped it up to 20,500 you could put away within the year.
Yes, they did. They changed it. The CPI index went up, so they raised it from 19.5 to 20, and that's the max you can put in. You have to do it by percentage of pay. So you got to figure out, what percentage of your pay will get you to 20%.
Correct. So I have that, and then in addition to that, so to save extra from taxes, I have a 457 as well.
Great.
So my question is, like, if I have a Roth in my 457, and then like my retirement is a 403b with the retirement system.
Yep.
Like, I'm trying to see, because you can't roll that over into one, correct? With a Roth and a regular, you can't do that. So is it beneficial to have them separate like that? So you have like where you don't get taxed in a Roth later on, or would you like prefer having them both the same and being able to roll them over once you start to retire?
So you can do. So you have a Roth in the 457. You can roll that out into a Roth IRA, just as in the 401k plan, you could roll that out into a rollover traditional IRA. So you're not stuck in these plans forever. If you leave your job, you can roll these out. They just stay in these slightly different buckets, Roth versus traditional. But having the opportunity to save both ways, both pre-tax and after-tax, tax-free forever, is highly advantageous. And I say that because the one thing I didn't mention, it will be part of our presentation next week, there are income limitations on your ability to contribute to Roth IRAs. So while you're young and not making huge amounts of money, take advantage of the Roth.
Okay, thank you.
You're welcome.
Wait, just for a resident.
Karen, you have a question, Karen?
Yes, and just before we close, I would like to confirm. So when we say that we make these investments, I don't really have to sell my stocks if I don't want in order to get return. Like, so because I was confused, like how you make the money. Either you sell the stocks when they are high or dividends.
So you have a target date fund, correct?
Yes, I do.
So you don't have to worry about anything because they're going to make all those decisions for you. So what you want to do is maybe once a year, look at the statement, see how the fund is doing. You don't need to look at it every day. You can't do anything about it anyway. Over the long term, this should do very well for you. And all you want to do is periodically take a peek at it. But you have no work. They do all the work for you.
Thank you so much.
You're very welcome.
Brandon Walsh.
Thank you. I really have enjoyed this talk, and so I just want to thank you for doing an excellent job. I think it's very helpful. And I do apologize, I missed part of the beginning. So if you spoke about this, that's you can just say that, and I'll look for the recording. Also, you alluded to you may be speaking about this next week, and if that's the case, that's also fine. I'll stick to you for that. But did you speak about rolling a Roth IRA once you are no longer to directly contribute or backdoor Roth accounts?
So I didn't speak about backdoor Roths, which may change under the tax code. There's a proposal to eliminate that as an opportunity. But with a Roth rollover, are you speaking of moving it out of a Roth 403B into a Roth IRA?
I don't think so. I think it was more of a traditional to a Roth, a traditional IRA.
Okay. So when you can do a traditional IRA and roll it, effectively convert it into a Roth IRA. And people do that because they realize I've got all of this retirement money. And when I take this out as a retiree, every nickel is going to be taxed. Whatever I withdraw, 100% taxed. I have an opportunity now to roll over this IRA from a traditional to a Roth. You pay the taxes on it now. Okay. So who does this make sense for? People who have low incomes. If you are a student, you don't have a job, you've got this traditional IRA, might be a good time to roll it into a Roth IRA, pay the tax now because you don't have a lot of income, not going to have a big tax bill. So that could make a lot of sense. Then it grows tax-free forever.
Oh, very nice.
Yes.
Very nice.
Thank you. Sorry.
You're welcome.
So Keanu and Edward, your hands are still up. Do you have questions or are they just left over?
I had a question. So I was wondering in terms of, because a few times you mentioned losses covering gains. So I was wondering, yes, like, if you have enough losses to cover your gains, would that mean that you didn't make a profit for the year? Or like, how does that work?
Not necessarily. You may have a portfolio that has done really, really well. And your challenge, if you have a brokerage account, you're invested in different funds and different stocks, it goes up in value 20%. You want to take some money out. You notice that among all of these different stocks, you have some that lost money. And you're thinking, maybe I don't hold on to it any longer because the prospects for this company, I just don't think it's going to turn it around. You can sell a winner and maybe you realize $5,000 in capital gain. You sell this loser, it's down in value $3,000. You eliminate $3,000 in gain. So now you're only going to be taxed potentially on $2,000 of capital gain. So matching winners and losers when you look to take money out of the account can be an effective way to control taxes.
Oh, I see. So you're still making money in a sense because of what you keep in the account.
Yes. Yes.
Okay, thank you.
But when you have a taxable account and you want to reposition your investments, you have to think, I could have a tax bill here if I sell my Tesla and it's up 300%. So it's something to bear in mind. Mm-hmm.
I had a question. Someone said that they have a 457. What's a 457?
So a 457B account, and again, that number refers to that part of the tax code, is a payroll deduction tax deferred annuity savings plan. So it's pre-tax, you put money into it, and it's got the same retirement restrictions, meaning that you can't take it out before age 59 and a half. It's another way to save on a tax advantaged basis. And you're lucky you work for an institution. Nonprofits and schools can offer 457B plans.
All right, folks. That's the last question. This has been a nice, lively discussion. I'm glad everybody's engaged in asking questions, what we want for all these sessions. We'll be back again, same time next week. It's every Tuesday for the month of February for Black History Month. Come get your financial literacy on and participate in the investment game. I think it's going to be fun. Until next week, thank you, Anthea. This has been great, as always. A lot of information, a lot of energy. We're going to try and limit it to an hour next week. This is a lot of information. I don't know about you all. It's volume overload. But we're trying to get as much as we can into this month. But again, tell your friends. You can see this is good information. Anthea's not trying to sell you anything. No. She's just giving you straight up information. And that's the benefit of this particular approach. She doesn't work for any brokerage firms. So see you all next week, and enjoy the rest of your week and weekend.
Thank you.
Thank you.
Thanks,
Good night.
Anthea.
Bye-bye.
Thank you.
Please invite anyone that you want to come and get some financial literacy.
Thank you so much. Take care.
All right.
Thank you. Good night.